Okay, have you ever thought how much water do we require to make one A4 size paper in India? A society, a group of people had the same question in their mind. They just want to know how can we conserve water by making some adjustments in the production process happened in A4 size sheet papers. Okay, so they made some calculations. Okay, to find this, they formulated a formula that can help them to find how much water is used to make just one sheet of paper. So this is the formula. They just took the total number of A4 size papers produced in India and divided it by liters of water used in the industry. So it is easy for us to know how much water is used per paper. That means for making just one A4 size paper, how much water is required. That is what they want to know. So after making this formula, they just collected the data and found that for making 1 crore A4 size papers, the industry needed 10 crore liters of water. Okay, this was what they found. To make 1 crore A4 size paper, we need 10 crore liters of water. Simplifying it, they found that the ratio would be like this. The fraction would come like that. Okay, that is the crore and crore is cancelled. Now we have just 1 by 10, which is equal to 1 is to 10. Okay, what does that mean? When we say the relation between A4 size paper produced in India and the water required in the industry is 1 is to 10, that means that to make one single A4 size sheet paper, we use 10 liters of water. Now the question is, now you know that a society had the question in their mind. They found to answer that question. What can we do with this answer? Now we have a final answer. When we just saw here, it went easily, but when you think about the process, it is very difficult. For a long year, they just went around all the A4 size production units. They just collected how much water they use, how much paper they produce, and they came to this answer. Now the question is, what can we do with this ratio? How can this ratio help us? Yes, now we have stated a ratio, right? Now let's see why we state this kind of ratio. There are mainly three reasons. First one is we can understand the relationship. Now we know that. Now we can say anyway easily that the relationship between A4 size paper and the water used for is what? 1 for 1 A4 size paper, we need to use 10 liters of water. When we said it is 1 crore is to 10 crore, okay, it was something huge. It was a real data, okay, it was a real number, but it was huge. And also remember, it won't be just 1 crore, it can be 1 crore 24,000, like that. 10 crore also can be something else. So now we have a easy terms to state the relationship. That is the very first objective. And the second one is, now we know the requirement of one in terms of other. See, we know how much water is required to make one A4 size paper. Think you are going to start a new plant to make A4 size sheet papers, then you need to worry about the data. You now have the answer that for making one A4 size sheet of paper you need 10 liters of water, so you can arrange water accordingly. Now the third is the most important thing, we can state a control. Think the usage is high. We can just assume now when one single A4 size paper sheet is produced with the help of 10 liters of water, means we are using a lot of water for that. Now we need to reduce this. Okay, so we need a benchmark to reduce something, to control something. We need a benchmark. Now we know we are using 10 liters of water to make one A4 size paper. Now how can we control it? We can say through some measures we control it only when the production requirement of water, okay, the production requirement of water reduces from 10 liters. So just imagine next year when we, after implementing some sort of controlling measures, we just measured how much water is now required to make A4 size paper. Then we got the answer to make that A4 sheet paper. Now we just need 5 liters of water. What does that mean? Yes, we have controlled the usage of water. We have reduced it. Our controlling measures are effective. So, to set up a controlling mechanism also, a relationship like this is important. A ratio like this is important. Now, we have seen what is ratio generally and what are the main three objectives of ratio in a general form. From this, we can move on to our topic, which is financial ratios. Financial ratio is a fundamental tool in financial statement analysis. Here, just to note two things. We pick up some elements from balance sheet and profit and loss account, and we do what? We will make use of this information to make comparison. We compare one item in terms of another. We see the relationship, we see the change, we predict, we do many things with that. Okay, so that is the basics of financial ratio. Now, here is the meaning and the definition. Okay, just see the definition. Financial ratio is the process of computing, determining, presenting the relationship of item and group of item in financial statement using ratios and interpreting the result. Interpreting is an higher end part. We just doesn't need to get worried about that. Just think how we can make up the ratios. Okay, now just see some of the objectives and importance of preparing this ratio analysis. There are many importance. This first one, it is an aid for comparison, isn't it? We can compare when we find a ratio. We just make a comparison between two firms, or it can be within our firm itself. Just see now industry in India. Okay, the A4 size industry in India said that they need 10 liters of water. Now they can compare this with what happens in China. If China just uses A4 for one A4, they just need 1 liter of water. There is a great difference. Now we have compared and found there is a great difference. And what we can do? We can try to adopt the measures used by China here. So ratios act as a aid for comparison. The next one is financial forecasting. See, like what we did in A4. I am just repeating the A4 example only for you to understand, but in finance different things will come up. Okay, to make one A4 size paper we need 10 liters of water. That means what? To make just think we are making 10 A4 size papers in an year for a business. That means we need 100 liters of water. But in future, just think in future we are going to make 100 A4 size papers. Then what we need? We need 1000 liters of water. We just multiply 10, 10, 10 here from the basic ratio that we found out. Similarly, in case of finance, we can also do what? Find relationships like this, and we can forecast what will happen in the future. We can make projections. Also, we can control the cost, like how we control the usage of water in A4 size. We told in the beginning, right? Usage of water, we can control cost in finance. Now we can understand the trend using these ratios. Also, there are some ratio which measures profitability. Just understand, profit can be gross profit or net profit in business. Also, a new term for you, operating profit can also be considered. So what can we do? We can profitability can be measured from these three angles. Okay, so it is up to the person who makes the measurement to pick which of these to measure the profitability of a business. For some people, gross profit will be considered, others will consider net profit, others will consider operating profit. So there are different ratios which measures what? Each kind of profitability. At last, what they know at the end of the day, they just want to measure how much profit what is the profit making ability of the business. Ratios give an easy and simply representing terms for that. Also, solvency. What do you mean by solvency? Solvency is the ability of the business to meet long-term debts. Okay. Also, when we measure solvency, we would like to know the presence of debt fund in the whole business. Similarly, we look for liquidity also. When solvency means long-term debts, the ability of the business to meet long-term debts. Liquidity means ability of the business to meet short-term debts. So we should be aware about the ability of the business. Why we are aware? Because basically investors are aware, very concerned about that. Before The investors, especially someone who is looking to make a long-term investment, will have a concern, okay, about the solvency or the liquidity of the business. Solvency means when they look in long term, is there any chance that the company become a insolvent company? Insolvent company means a company which is unable to make payments on its debt. Just think about Byju's. Byju's is one such example to become insolvent. Similarly, the investors would like to know whether there is a chance for the business to become insolvent, or what sort of liquidity they have. The degree of liquidity also they are concerned about, because they want to know how much the business have the ability to meet short-term debts also. So solvency and liquidity test is done easily with the help of different ratios. We will go through those ratios, don't worry. And the next one is, it is a tool for control. We have told about controlling before. It states the relationship. Okay, when we use ratios, it states a relationship. What if one is this many, then what about the other? So it states the relationship between two things. Now, as we said in the example of A4 size paper and water, they are two different things, but it states the relationship, isn't it? For one A4 size paper, how much water we need. Similarly, in finance also, we can state relationship between two elements of the financial statements, whatever it may be. It can be gross profit and net sales. Just think, we are taking the gross profit ratio. Okay, when gross profit ratio is taken, we take the relationship between gross profit and net sales. Now, if the answer is 1:3, just think it is 1:3. We have found a relationship between the net sales and gross profit of the business. That is, the gross profit would be 1/3 of the net sales. Hope the concept is clear. Now, we are saying the advantage, since we have early told about the objectives of the preparing ratio analysis. Now we are going through the advantages. Simplified financial understanding. It simplifies, isn't it? Very simple analysis made there. It shows the trend we have discussed before. It helps in comparison. It makes a standard for comparison. Okay. Then the communication makes effective for every year. Just once again consider the example A4 size paper and water. Okay. Now when the communication become easy, we just want to tell them whether our controlling measures of reducing the usage of water was effective or not. If we are using ratios, it is very easy to mention that. Well, how? In the first year we had one A4 we need 10 liters of water. Now we can tell when it came to the second year, for preparing one A4 sheet paper we just need 6 liters. Now we easily conveyed that our measures was effective. Similarly, in finance also, when we think that something is higher or something is not up to the level we expect, we can make change, represent the two ratios in two different years and show yes, the change has made. Our measures to make the change is effective. Okay, similarly we can tell. And another one is, it is easy for assessment. Okay, we have told right now, it makes easy for assessment. And the measurement also, see, when we want to make a comparison, we surely need a benchmark. So the ratio will act as a benchmark, making the measurement efficient. Cost control we had told before. Okay, it is a tool used by, very popularly used by management to take decisions. Okay, when they want to take decision, they need some mathematical supports to the claims, judgments that they make. So ratios act as a judgment tool for the management. Management means the top level management of the business. Also, when we talk about the objectives and advantages of ratio analysis also has some sort of limitations. What are they? We can see. The very first thing is, we need to know multiple ratios. See, one single formula can't do the whole business. If you want to know different things, we should by heart different ratios. When you come to the practical part, you will understand that. Okay, that is one of the major difficulty, because if you want to know liquidity, if you want to know the profitability, if you want to know the leverage of the business, for each thing you would have different ratio, and in each of these section also there will be thousands of another ratios available. So which is the best one? We don't know how to find it. It depends on the knowledge of ourselves, so it becomes confusing for us. Also, we don't consider any kind of quality data. See, when we talk about ratios, remember it is purely a part of statistics. Statistics have limitation to consider quality data. Okay, quality data means a thing that emotions, something like emotions, or what we can say, something like the likeliness. All these things can't be measured through ratios. We have limitations of measuring it through ratios. So we could say that only quantitative data is considered for making ratio analysis. Also, we are depending much on historical data. Historical data means we are making assumption. This thing, the gross profit ratio of this year was 40%. Now we will assume that the next year also we will get 40% as the gross profit ratio. Gross profit ratio means the percentage of gross profit in the total net sales. Okay, now if you made a sale of rupees 100, we will get 40 rupees as gross profit. We got 40 rupees as gross profit in the last year, thus we expect that it will happen in the next year also. But future is bloody unexpectable, unpredictable, and there is no 100% sure ground for making such an predictions. Okay, since the only option available for us is to just take this historical data into consideration, make some assumption upon that, but it needn't be correct, so we hardly rely on other matters. Okay, now the another limitation is lack of absolute standard. Yes, there is. We can't say, when you come to the practical part, you will see that many of the ratios don't have an absolute standard, but some have. Okay, for example, there is one ratio called current ratio. Current ratio is equal to current assets divided by current liability. Current ratio look upon the liquidity of the business, that is the ability of the business to pull out some liquid cash. How easy is it to pull out some liquid cash? Okay, basically we will say that it should be at least 2. When we divide current asset by current liability, the answer should be at least 2. But this is not specific for all industry. This is not a standard set by any organization. We very commonly use this as a standard. So to make a comparison, to put a comparison, we don't have a proper standard for this ratio. There is nothing universally accepted. Yes, that is a correct word. There is nothing universally accepted, but what we can do, we can just make a comparison with what we had in the past year and what we have now. Or with that we can make expectation what should happen in the coming year. Unless we don't have an absolute standard globally accepted, this should come surely. No, we can't tell like that. Okay, now moving on to the next limitation. The potential for manipulation is limited. Yes, why? There are chances for misunderstanding or taking it wrongly or representing it wrongly, these ratios. When you are doing it in practical, you can understand. Since one ratio become unfavorable, okay, just think one ratio become unfavorable, it doesn't mean that everything is going unfavorable. But if the investor is highly depending upon one such ratio, what will he feel? He will feel the whole business is going in a wrong way. Just think, a business have very less cash remaining with them. Okay, the same time it has so much of opportunity upcoming, so much of new opportunities are upcoming for the business, but it has a very little cash remaining with him. So think one investor just look at how much cash it has remaining with them. When he found it has very few cash, the investor say, oh, this business is not going good, I don't want to invest in this business. What will happen? He will miss all these opportunities. So it is not good to highly depend on ratios. It can, if you don't know how to properly interpret, it can mislead you. Another one is the means, not an. It is said the ratios are tools for analysis influenced by the analysis skills and bias. Yes, this thing had to be discussed very deeply. I am going to discuss like that. But please understand this. Bias means that mistakes that one can make. Okay, It can be made knowingly or unknowingly, whatever it may be. So when we say it is biased, what does that mean? It means that there are chances for the analyst, the financial analyst, to make some wrong interpretation or something made up from his sort of mind. He would have some kind of mindset. He will find something favorable, he will find something unfavorable. Being a human, financial analyst can make any such interpretation. He can include his personal interpretation into that. In such cases, there are chances financial analysis, the ratios would show wrong way for us to travel. It will guide us through a wrong way if the analyst input some personal biases to the interpretation. Another thing is, it can't be set to a complete information. Something would be missing there. Leave it. Very important part, how we classify the financial ratios. The very first classification is profitability ratio. Don't get confused with what is written here. Just understand profitability ratio means we are going to look profit of the business from 3 different angles. It can be from gross profit, it can be from net profit, and it can be from operating profit. What is gross profit? When we deduct our cost of goods sold from net sales, we get the profit, gross profit. When we deduct all other possible expenses from the gross profit, we get net profit. And when we deduct all the operating expenses from the net sales, what we will get? We will get the operating profit. Don't just get confused. These are the 3 types of profit a business can measure, and based on these profits, we are going to see how much does the business, how well do the business perform. It depends upon, once again I am telling, it depends upon the choice we make. Either one can choose gross profit to make the comparison, then he should rely on the gross profit ratio, or else he can go for the net profit ratio. Whatever it may be, it depends upon the person who makes the interpretation. So we will, in profitability ratio, it is a category of ratio where we look into how all we can take the profitability of a business to compare the performance of the business. Now, liquidity ratio means liquidity is a quality. It is an attribute. Liquidity is an attribute which states that the easiness of the business to collect cash or bring up some liquid cash. So liquidity ratio measures how easy can a business meet his short-term or long-term obligations, or how easily can they bring some money out of the business. That easiness is measured here. Leverage ratio measures the mix of debt and equity. How usefully or how brilliantly have the business used the mixture of debt and equity. What is the proportion of debt fund and equity fund? It can be 70-30, it can be 20-80. What is the ratio of debt and owner's fund? Debt fund means we have borrowed from somewhere. Owner's fund is a fund provided by the owner of the business from his own money. So leverage ratio look up into such things. What is the effect of debt on the total fund from different angles? Turnover ratio. When we hear the word turnover, we often think that it is what? Sales. Don't think turnover is just sales. Sales is one of the turnover. Turnover means the change from one position to another. So turnover ratios look up into how much time something, whatever it can be inventory, it can be our debtors, whatever it may be, how much times do one particular thing change from one position to another. When we do the practical part, you will understand it better. Now we can have a quick look on the basic ratios that we should know. In profitability ratio, we have gross profit ratio, net profit ratio, operating ratio. Turnover ratio includes stock turnover ratio, fixed asset turnover ratio. Liquidity ratio includes current ratio, acid test ratio, and absolute liquidity ratio. I am not explaining it here because we are going to see the practical part. Don't worry. And finally, we have some more ratios. Just forget about, don't get confused. You feel that you have a lot to learn about ratios. Don't worry. Yes, it is true that you would have to by heart a lot of ratios. Why? Because we don't know which is the aptitude. It depends upon the person who is making interpretation. Okay. Now we know the ratio. Why do we need the ratio? What type of ratios are? What are the uses of ratio? All these things we have discussed. If you feel any difficulty, please let me know. We can have some more detailed discussion. Thank you.